So I'm just going to give a very quick intro on Parker. So Parker comes from an education background in informatics, political science, and intellectual property law. He held engineering and BD positions at Pivotal Labs. He started his venture career as a partner at 500 Startups in 2013. Many of you probably have heard of 500 Startups as one of the well-known incubators in the Valley. And he's recently become a partner at Angellist. I think one thing that's really exciting about Parker is there's a Twitter handle that's gotten a lot of buzz in Silicon Valley called Startup L Jackson. And of course, Parker just came out as the beloved Startup L Jackson on Twitter. So maybe you can talk a little bit more about that at the end as a fun fact.
We can talk about Twitter. So you stole my first section, which was what I've done, or who I'm. I'm going to try to just talk to you guys a little bit about Angellist, and we can talk about early stage investing. That's what I've been thinking about for the last 3 or 4 years. To give you a little bit more context on me, I studied intellectual property law at Berkeley. I hope it's okay that I'm here. And went to a place called the Internet Archive, which is a pretty interesting organization, nonprofit in San Francisco, which is a lot actually like a startup in a lot of ways. Spent a couple years there, did a startup that was way too early and learned a lot of lessons before joining a company called Pivotal Labs. So Pivotal, for those of you who may not know much about it, is a software consultancy that works with a lot of the top Valley firms. So I got to spend about 7 years building that company. We went from 5 people to an acquisition, then spun the company back out. It should IPO in a year or two. It's a couple $1 billion company, so it ended up being a very kind of classical Silicon Valley company. But I actually just went there because I'd been the CTO of the startup and realized that I was a pretty good programmer, but not very good at building teams and building companies. So I went there to learn how to do that stuff and stuck around longer than I thought I would. Spent a couple years at 500 Startups, and that's where I really learned venture. So I ran their San Francisco accelerator, built up the team there, helped them scale. I think at the time I joined, we were probably doing about 100 investments a year, and now they're probably doing 400 or so, which is kind of crazy. About on par, by the way, with what we're doing at Angellist these days. So I inadvertently became an expert in volume investing, if you want to call it that. And now I sit at Angellist, and my role is basically just to be oil in the machine is kind of how I think about it. Let's make the marketplace work. Let's connect startups with investors, with syndicate leads, with backers, and fix any problems that we hit along the way. So I guess to get into Angellist, do you guys have a sense of, do you guys know what Angellist is? A little bit, yeah. So for anybody who doesn't, Angellist is a marketplace that connects startups with capital. And it turns out that the early stage of the market is still incredibly inefficient in this way, right? If you're a startup, it takes you months and months and months to raise capital. And if you want to invest in startups, particularly if you're not really in the scene, it's very hard to do so. So capital is trying to get into these startups are trying to get capital, and everybody's really frustrated, which is exactly the kind of situation which says, oh, there should be a startup there, right? So the startup was founded in 2010, and actually they were a customer of mine at Pivotal, so that's how I got to know the founders there. They came in, we built the first version, helped them get it launched, and then they built their team around this product and kept on running. And I guess to give you a perspective, so we're about 5 years in, and I think it's still very early if you look at this business. So we could talk about kind of where we're at and sort of why we think it's early and what we've accomplished. But I think that's something that I like to impress upon people who are thinking about getting into startups, that you read about these things and you're like, oh man, that was an overnight success, and that's true. But it's like night 1500 as opposed to night 4. These things take a long time to build. So I think we very much look at it as early days. So I guess to talk a little bit about what Angellist is and how it works. By the way, interrupt me anytime, because I always hated sitting in lectures and just listening to someone talk. So feel free to throw questions. Angellist as a piece of technology is actually pretty basic. even without a CS degree, you could probably build what we built. And that's a lot of startups in the Valley, right? It's very much about business model innovation. So from a technology perspective, we built very classic marketplace technology, right? We have people who are accredited investors who want to invest in startups. Great, so we can write some software that lets them sign up, that verifies that they're accredited, that tries to measure their sophistication and help them invest in things that are appropriate for them. So for some people that's picking individual deals, for some people that's picking individual investors to back, and for some people we say, hey, you can only invest in funds. So it's fairly basic technology like, let's hook up with your bank account, let's collect a bunch of data from you and try to figure out how sophisticated you are. Let's build some forms that allow you to say what you want and put things in front of you that might be interesting to you as a backer. So it's innovative in the sense that no one's ever done it. You couldn't go online and find startups to invest in 6 years ago. But from a technology perspective, and I think you'll find this in a lot of the startups that are out there today, the technology in and of itself isn't that hard, right? It's really the problem that is challenging. So we have the site. You can go and you can sign up and you can log in and you can see some stuff, right? The other part of the business that's really is maybe a little bit more innovative is the legal side of the business. So it's something I think people don't understand. So you guys will leave this room knowing more about Angellist than most people out there. Sort of what does it mean to invest in a startup, right? If you are wealthy, you can go and you have a friend who's building a startup, you can just write them a check, and that's pretty easy to do, right? That's sort of what the market considered. And if you're a venture fund, it's actually pretty easy too, right? You've set up this fund, the SEC said, all right, we kind of know what you guys do, although they don't really know, they don't really think about us very much. But the fund could come and write you a check, and that's really easy, and you get the money next week, and that's all good. What Angellist has really done is said, cool, well, there's something maybe in between there that's interesting, which is, what if when a startup wanted to raise money, we call it a pop-up venture fund. So effectively, every single investment we make is a venture fund with exactly one deal in it. And it's kind of that simple. So we do, we'll go through stats a little bit later, but we're doing about 500 deals a year now. So you get an idea, right, of the pace that we're going at with a very small team. And we've done that by actually really innovating on the legal side, right? So for about $8,000 today, we can create a venture fund and make an investment and administer that investment for 10 years, which is pretty crazy, right? That's pretty cool. So when you think about where the innovation is in this business, I would make the case that it's actually much more on the legal side than it is on the technology side, right? And we've gotten this to a point where this is incredibly simple. This just works. And so we're kind of still constrained by what the SEC regulations have to say about how these things go. So for example, you can only have 99 investors, which is fine for a venture fund. It turns out to have some limitations in terms of the kinds of things we're trying to do. We could talk about the SEC if you guys are interested in sort of, yeah.
Just a quick clarification. So in order for you to be that transaction element between an investor and that startup,
yeah.
When that investor wants to invest in that startup, you create your pop-up venture fund. It costs you $8,000 to do that, to basically connect the two and administer the funds?
Yeah, so the question is like, what exactly does that $8,000 do, and what are we doing? So what we're doing is we're creating an LLC, which if you look at venture funds, they turn out to be LLCs. We're creating an LLC. We are marketing that, or rather the syndicate lead, which we talk about kind of how these things are put together. We're marketing that to potential investors. If they commit, they wire us money, they get a proportional interest in that LLC, which we then administer, much like a venture fund, right? It has pro rata rights, it has legal rights. Where it gets funky is like Angellist administers that on behalf of these, we call them backers, and this syndicate lead who's basically the venture capitalist. In a traditional venture fund, the venture capitalists are what are called ERAs, which are basically like they can make investment decisions and sign on behalf of the fund. We actually do that on behalf of these folks, which is a kind of a corner case the SEC hadn't really thought about. Like they just never thought that someone would do what we're doing. But yeah, for about $8,000, which covers the cost of incorporations, the cost of audits, the cost of taxes and all of these things, we can just make it work. So if you have a great startup, and you guys are all sitting here at Stanford, there are great startups happening. You see the startup, you're like, wow, this thing's awesome. I'm gonna call 10 of my friends, and together we can put together a couple $100,000. Maybe this will be you guys in 5 years or something. You can put that money together, pool it, put it into one vehicle that writes one check into this company, which turns out to be actually really good for the company, right? They don't want to deal with 10 or 20 or 30 people. They want to deal with one person for corporate actions, for follow-on investing and all these things. And so today, $8,000 is what it cost us to do this. There are some things we can do with our business to lower those costs so that it's less of an overhead, because there is kind of a lower bound on the size of these vehicles at this point. But it actually works pretty well. Think about an average round for an early stage round being a couple $1 million, and these checks are $100K to $500K. The overhead is manageable, given that when these things win, they win really big, right? So I think that to me is pretty interesting, right? Like for $8,000 and in a day, we can do one of these investments, and with a team of about 25 people, most of whom are actually engineers. So we've got 3, 4, 5 people really focused on putting these things together. We can do 500 of these things a year. So that's pretty significant leverage that we have on these people. When you think about the fact that an average venture fund is actually doing one of these vehicles every 2 or 3 years. Let me just stop there. Do you guys have any questions on sort of the legal structure and how we put these things together? Yeah.
It's a little bit less on the legal structure, but more on like, are you guys taking a percentage of the deals that you syndicate? Are you taking carry on that?
What is our business model, right? Yeah, it's a great question. An appropriate question for the times, I think, as well. We take carry on capital that we bring into deals. So if you think about, and this is actually a great transition in what I want to talk about next, which is like, what is a syndicate and who are the people that participate in it? So here's this LLC. Let's say you have a great startup that you want to invest in. You would be what we call a syndicate lead. So you would bring this startup to the platform and say, I want to invest in this deal. Here's why it's a good deal. Andreessen Horowitz is leading the deal. I know the founder. Here's my thesis. I've got this allocation. And you might bring a couple $100,000 to that deal. In addition to that, you might say, great, I know where to get $200,000 of people who want to invest in this thing. But actually, my allocation is $500,000. Can you help me fill that out? And we say, well, yes, we can. That's our business. So we're going to introduce this deal to capital that doesn't know you. And if they invest and that deal is successful, we take a percentage of the carry on the back end. So it ends up being effectively free to the startup. It's effectively free to you because it's money that you wouldn't have had otherwise. And then we take 5% carry, which in a standard venture fund, it's about 20% carry typically, give or take. So we're taking about 25% of the carry across the capital that we're bringing to these deals. Does that answer your question?
Yeah, is that the exclusive way that you guys generate revenue? You guys aren't doing any sort of like asset management model like a lot of these other folks will, where they do like a 2 and 20, or you guys just exclusively the 5 on the back end?
Yeah, so that's a great question. The question is like, do we do a 2 and 20 like a traditional venture fund? And the answer is no. So a traditional venture fund will charge 2 and 20 or some variation of that, where they're generating management fees, which allows them to hire people, often like you folks, to go and work day to day on these funds. Where I think Angellist is very different than a traditional fund model and really compelling to me is I think we unlock a new kind of venture capitalist. So we call it Angellist, right? Angels traditionally have not been professionals. They have full-time jobs, right? So I think what we're doing is the way I look at it is, if you're a startup, the reason you care about Angellist is because we can put somebody on your cap table and put them there in a way that's better for you, who wouldn't have otherwise been there. So we can put money behind somebody who you want to work with, who isn't a full-time VC. And often those people are actually better for your business or better for you, right? Operators in your space, for example. So I think where we can be really impactful on the ecosystem is, like I say, putting better people on your cap table. And that's really relevant in these early stage companies. So maybe we can talk at some point about the broader sort of market and what the seed stage market looks like, which didn't really exist 15 years ago at all. And I think in that space, if it is the case that today you raise your Series A with millions of dollars of revenue and 15 or 20 people on your team, it basically effectively means that you're on your own until then, which wasn't maybe the case 15 years ago. And so if we can then bring people in who are investing and we can basically put money behind them, I think of it as like paying them for access and expertise. And what you get as a startup is that they can come in and help you. That's a win for everybody. Because those people aren't full-time at this, they don't necessarily need management fees. So we are looking at, there is a segment of Angellist users, as you might imagine, who are the power users, who are starting to basically turn this into a full-time job. And for those folks, they're starting to think about like, well, how do I do this sustainably? Because we give them a lot of leverage on their capital, but we don't give them cash flow. And it takes years and years for these things to return. So I think we are not in principle opposed to management fees, but because the structure is so different, it's just, here's this pop-up deal, here's this one deal. It's not quite clear what management fees would mean on a deal-by-deal basis, because it's just different than what funds do. Does that answer your question? Yeah.
I'm just trying to sort of see how this relates to the SEC rule last year allowing individual contributors. Does Angellist try to use that new rule, or
So the question is like, what is the SEC doing and how does it relate to what we do?
Yeah, I think there was this rule for like, so that crowdfunding.
Crowdfunding, yeah. So a common misunderstanding about Angellist is that it is, people will say, oh, it's crowdfunding, right? And I understand why people lump it in there. It's just not crowdfunding. So I think the problem with crowdfunding with respect to startups is that when you think about this business and you think about where the bottleneck is, like what's the bottleneck? It's not capital. It turns out to not be the problem, right? It turns out that the bottleneck is startups. It's good opportunities to invest in. So when you think about crowdfunding, I think there are like places where crowdfunding can be compelling. Like you're making a CPG product, you're selling, like I saw one that was like grasshopper, like power bars basically, right? That's actually go crowdfund that and get a bunch of investors who love your product. That's probably a compelling use case for crowdfunding. Just get as many people to give you any amount of money that they're willing to give you and call it good. I think in our case, when you think about what the bottleneck is, great startups don't need more money, they need better money, right? They need money associated with better people. So I think what syndicates allow us to do is put value add investors for small amounts of money into these companies. So it's just not economical for a startup to take $1,000 from somebody, even if they're useful. But it actually works really well when you have a syndicate. And it's not necessarily always economical for somebody who could be a syndicate lead but didn't have a giant exit. So a lot of our syndicate leads are people who are, they've had good exits, they have a lot of experience, they'd be a phenomenal help to your company. They just don't have enough money to write $100,000 checks here and there and everywhere forever, right? So I think what Angellist does that's interesting is it creates a vehicle through which that person who has a little bit of money can create a syndicate and really dig in and help you. And it creates a vehicle through which other value add people can invest in your company. And that's great for you because now you've added 3, 4, 5 people to your cap table that can actually help your startup for very small amounts of money in a way that's low overhead. Crowdfunding is just money, right? And I don't think that that is the problem that certainly good startups have. So I think there are various models around what I would call alternative funding for startups. And the ones that are probably most interesting are things like Angellist or things like Funders Club, which Funders Club, you actually have they're a VC, right? Like they have a team and they look at deals and they're very smart. So they've innovated on the back end in terms of how the capital comes in. but on the front end to you, they look quite a bit, not exactly like a normal VC, but quite a bit like a normal VC. So I would say that these are the kinds of models I think that make sense for startups when you think about innovating on financing, because at the end of the day, good startups want to work with people who can help them, differentiated capital, as opposed to just piling in money. So I tend to think that the people who are trying to do crowdfunding for startups are going to end up with this negative selection bias problem where it's like, well, I really want to raise from smart people, but I couldn't, so I'm over here. So I think the SEC, the SEC is a long way from San Francisco, and they're smart people, but like we're this little teeny thing in this big ocean of problems that they have. And I mean, it's useful. I don't know off the top of my head what the numbers are, but if you look at Wall Street, you look at the public markets, you look at hedge funds, you look at some of these other things that the SEC is concerned about, like venture is this little speck, like we just don't matter. So, and we're very far away, everything else is out there. So I just don't think they're not thinking about us, right? Like crowdfunding is just kind of this thing that's happening over there, and I'm not sure it's going to be impactful. We'll see.
I was wondering how worried you were more at the beginning of Angellist about how the division of responsibility was going to be for the people who leave the syndicate.
Yeah.
So say if you invest previously without Angellist in 5 companies, you can give a lot of time to those 5 companies, but now if you can invest in 50 companies, are you still giving them the same attention, and like is that really still the same amount of smart money?
Yeah, so the question is, did we think about what this new structure, how it would incentivize these angels and change behavior? So for what it's worth, Angellist was a client of mine when it started. I wasn't thinking as deeply about the problem set that they had, but I think that is a question that comes up. So there's a question, and like a good buddy of mine is, he gives me a hard time all the time about like, are we creating moral hazards, for example, with the leverage that we create for these investors, which is a fair question, because we have a different set of economics than a traditional VC fund, which we could get into if you guys want to talk about the economics. It's a little bit nerdy. We do think about it, but actually in practice, we have about 170 active leads, and we're doing I think it was like 470 deals last year. So if you really look at the ratio, there are investors who are doing on the upper end of that. It's probably 10 to 20 deals a year, which looks a lot like a standard like seed investor these days. So that looks a lot like a seed fund. The vast majority of them are doing 1 or 2 deals a year, which looks a lot more like a Series A investor. So I think in practice, what you tend to see is the opposite, right? You tend to see that somebody's putting in, $25K or $50K of their own money into a $300K round. They're doing that once or twice a year. And for them, that's actually a meaningful amount of money. So you're getting, as a startup, you're getting Series A level attention. I'm like, hey, I want to get my money back, at a point where funds actually don't just, to really be basic about it, let's say there's 2 kinds of funds. There's seed funds that do volume, and they don't have time for you because that's not their model. They're like, we're going to invest at 20 to 50 things a year, and we'll see what works. It's fine model. There's $1 billion A+ funds that are like, if we write you a $10 million check, we kind of don't care, right? And if those are the 2 models that you have to pick from, and you're a founder going, well, what's in my best interest? Actually, this is pretty desirable because it's in between, right? It's not somebody who's doing volume and writing, 50, 100K checks, and it's not somebody who doesn't get out of bed for less than $10 million. It's somebody for whom 25 or 50K is meaningful. They can rally some more money behind them, which means that they're more invested in my startup because their economics are aligned with mine, and hopefully they help me along the way. Does that answer your question? I mean, that's the ideal case. We hope that's everyone. I'm not saying that it always quite works out that way.
How should startups register for Angellist? At which stage will be more strategic? Should we have any leading investors? Or does Angellist provide any tools to promote?
So the question is basically, how should startups think about Angellist? Which is a great question. I think this is a but probably a very misunderstood thing in a lot of ways. I think startups often come to us when they're like, I'm trying to raise money and no one else will give it to me, which turns out we're not very helpful there. And so that's not what we are. We're not like a backstop for crappy startups. Startups can use Angellist in a couple ways, right? There's a directory, so you can go and you can put your, it's kind of like about.me or LinkedIn for a startup. Here's your startup profile. You can use it that way. You should absolutely be using it to hire. And we're mostly talking about the finance product here, but we have a great jobs product. So if you're a startup trying to hire, or you want to go work for a startup, you should just use the jobs product. It's phenomenal. In terms of fundraising, let me talk a little bit about how a syndicate comes together, what works and what doesn't work. So these deals get liquidity on a deal-by-deal basis, right? So the kind of startup that gets funded on Angellist is one that's doing a real round as opposed to a please save me, I'm dying bridge. They typically have a name brand lead investor, and the syndicate lead is somebody who's really useful and basically got into a competitive round because they can add value to the startup. So the right way to think about it if you're a startup is, hey, let's think about the syndicate lead as someone I want to work with as part of a bigger round. And so you can look at the syndicates page. We do a bad job at this. We should do this better. But we should help you find syndicate leads who can really help your company. And you should basically think about hiring them, right? You're like, I'm going to give you this allocation, and here's what I want from you. So it looks a lot like you'd think about an advisory relationship or a VC relationship. It just happens to be that on the back end, there's this syndicate vehicle as opposed to a venture check or an advisor agreement or whatever. So find a syndicate lead you want to work with, talk to them about it if it's a mutual fit. Often those people can help you raise your round. So you can find a syndicate lead before you have a lead investor and have them help you put the round together. You can, typically that's how it happens, or you do that in parallel. Some funds actually syndicate, so Arena is a good example, Nocation Capital, a lot of these smaller funds will actually syndicate part of their allocation, which can be good for you as a startup. I want Notation more invested in me, and there are economic reasons why it makes sense for them to do that. So yeah, think about it as part of a bigger round as opposed to, oh shoot, I need some money, let's go try to get a bunch of dentists in Ohio to invest. I always pick on dentists. I hope nobody's a dentist in the room. They're lovely people. I feel like there's another, did you, yeah.
Have you ever read any startups, non-US startups, or any plan to go abroad?
This is great. So do we do non-US startups? A little bit in Europe. We're trying to get live in Canada. We've struggled actually in Europe with liquidity, just liquidity around the deals. People, it turns out, who aren't in the US actually want to invest right here. So one of the things that you see when you open up a funding platform is, the folks in Malaysia don't necessarily want to invest in local startups. I mean, they may, and there's a market there. But when they go on Angellist, they're not going on Angellist to connect with other Malaysian startups. They're going on Angellist because now they have access to deals that are led by Sequoia and Kleiner and Andreessen and First Round and so on and so forth. And they don't have the ability to be LPs in those funds. They just can't get in. They don't see those deals otherwise. So it turns out that foreign capital actually is really greedy for a piece of Silicon Valley more than looking for a way to raise money locally. So I think over time, we will see the platform branch out, and we hope to be in every market everywhere. But as you can imagine, just market by market, the legal stuff is challenging, and then there's this sort of this challenge of liquidity. So even if you solve the legal problems, you've got to find great startups, and then you've got to find money willing to go into those startups. And those things are both hard in these markets. What you tend to find is a lot of the startups that are building globally, like if you want to start a startup and your market is truly global, you might start it in some other country, but you actually end up moving here for a number of reasons. So we saw that at 500 Startups as well, kind of this bifurcation, like there's local business models and you stay there. There's global business models, you move here, because it, at least today, is still the case that most of the time, the Silicon Valley version wins for reasons that, we could get into. Does that answer your question? Cool.
Yeah, so you said that you kind of want to think about, like, they're on the startup side, you think about hiring, like, when you're finding a syndicate, you think about hiring them. So I guess my question is, kind of to what extent is every member of the syndicate like involved in
The startup?
in the startup itself? Like, are they taking board seats? Like, do you guys
No.
drive the deal structure in any way?
No, so we think about it as a one-way relationship. So the startups can call the investors, but not the other way around. And startups are very sensitive to what information gets shared. I mean, there's a lot of concern and confusion around this relationship. Like, what is a syndicate? Because it's still a weird thing for startups. And so we try to make it very clear that this is a one-way relationship. So we want to bring value-add people. There may be people involved in the deal that are just capital, and that's okay. But it should be that this syndicate delivers you people that help and capital that you need without the hassle, without having to deal with, like, for example, 25 angel investors on your cap table, which if you've ever done this, like, you're like, I need signatures from 25 people, and I've got to chase them all down. It's just a pain in the ass. Like, we just handle all that for you. All right, let's see.
One more question?
Yeah, I guess.
Do you do any analytics on what kind of startups are actually raising, and sort of is there a bubble and things like that?
Is there a bubble?
Obviously, is there a bubble? But
Yeah, no, it's a good question though. So do we do analytics? Yeah, look, we have data on the market. We have pretty good data on the market because we are investing alongside all of the early stage firms that are investing and then through the ABC. I would say that the market is not nearly as bothered as people suggest that it is today. We do not see prices significantly dropping. We do not see volume of deals going down. We see later stage companies who have really screwed themselves having problems. We don't see a problem. The early stage market is really healthy. And so we look at that more qualitatively, but yeah, I think it's a great time to be investing in early stage startups. It's a great time to be building one. It's not such a great time if your unit economics are upside down and you raised $100 million to try to get out of that. Does that answer your question? Cool.
Sorry,
You're good?
we're running out of time, but thank you.
Yeah.